Terrific. So welcome everybody to our continuing distinguished speaker series of the Rutgers Center for Corporate Law and Governance. Can everybody hear me okay? Terrific. So this afternoon's session is called "The Role of Investors in Corporate Governance During the Pandemic and the Rise of ESG." That is quite an agenda. Before we get started, I'd like to introduce our co-dean, Kimberly Mutcherson, who's just going to give a short welcome. Dean Mutcherson.
Thanks so much, Arthur. I'll call you Professor Leiby. We'll be formal. It's a total pleasure to be here and to welcome all of you to this event. It's always the case that I enjoy the events from the Center for Corporate Law and Governance, in part because it is so far afield from the work that I do. And I feel like I learn something new every time I participate in one of these events. So I am grateful to our speaker for today. Thank you so much. I'm sorry that we couldn't actually host you in the building, but we'll make another invitation so we can see you back here at a later point. I think one of the things that's really interesting about where we are now in the world is that the conversations about corporations have really trickled down across very large populations, and particularly young people talking about the role of corporations and the future of this country. So I think this is a really wonderful time to have this conversation and to think about all of the issues that go along with big business in its own special way. So thank you all for being here. Thank you, Arthur and Doug, for continuing to do such amazing work with the Center for Corporate Law and Governance. And I will turn it over to Doug Shaw, who's going to move us on to the next part of the conversation today.
Great. Well, thanks so much, Dean Murchison and Arthur, Professor Leiby. And so I'm Doug Cha. I'm a fellow here at the Rutgers Center for Corporate Law and Governance. And I'm really pleased, and we're really lucky to have Amy Borrus here with us today. Such an important figure in corporate governance for so long. And a friend for a very long time as well. So thanks, Amy. I guess before we start, maybe, Amy, if you just want to tell us a little bit about the Council of Institutional Investors. Just not sure if everybody knows of kind of where that fits into the corporate governance landscape.
Sure. Well, first of all, Doug, thank you for inviting me to join you all here today. CII is very grateful to the Center for Corporate Law and Governance for partnering with us and with the Society for Corporate Governance on the December report on the multi-stakeholder working group on virtual shareholder meetings. But personally, I am truly thrilled to be here because I'm a Jersey girl. I was born in New Brunswick in what is now Robert Wood Johnson University Hospital and raised in North Brunswick. My cousin Bruce is a Rutgers grad, and this fall, my niece Maya will be a freshman at the Mason Gross School for the Performing Arts, where she will study violin. So I feel like I am home. So it's great to be with you. But just to talk about CII, we are a nonprofit, nonpartisan association of investors, of asset owners primarily. We focus on good corporate governance, strong shareholder rights, and what we consider sensible financial regulation that fosters fair and vibrant capital markets. CII was founded in 1985. Our members are organizations. They're primarily pension funds, so asset owners, all kinds of pension funds, but primarily public, corporate union, and some endowments and foundations. We also have more than 60 asset manager members, and that includes everybody from BlackRock to Wellington, and some non-US asset owners also. But we're primarily a US focused organization. And as I said, we focus on shareholder rights and corporate governance.
Yeah, and have been very, very influential on Capitol Hill, at the SEC, with other regulatory bodies and with corporations. And so Amy, let's get a little bit about your backstory and how you came to where you are. So tell us a little bit about your professional journey.
Sure. Well, corporate governance is my second career. Before I came to the council in 2006, I had more than 20 years as a journalist, almost all of that for Business Week. And when I got out of college, my goal was to be a foreign correspondent. I wanted to live abroad. And I managed to do that with Business Week. I got a master's in international relations from the London School of Economics. And when I was going through finals, I had taken a leave of absence from Business Week to do this. And the chief of correspondence called me in the middle of finals and said, gee, when you finish, would you like to just stay on and work for us in London? And I thought I had died and gone to heaven. And I spent 3 years working in London after the year in graduate school. And then I went to Tokyo and worked there for 4 years. And Japan was all powerful then. China was just a speck on the horizon. And then I came to Washington after that in around 1990 and covered just about all kinds of beats here. But the last beat I had was covering the SEC and corporate governance, white collar crime. And I loved it. But it was around that time that I decided I was tired of journalism. I had 2 small children and I wanted a more predictable life, work-life balance, which is, no one ever achieves that, but it was a pipe dream at the time. And I was just tired. I wanted to do something different. And through a fluke, I interviewed the woman who ultimately became my boss at the Council of Institutional Investors. And we got along really well. And she said, we have an opening, you should apply. And I did, and I became the deputy director here and I've never looked back. For me, CII touched a lot of important bases when I was looking for a new job. I wanted something where I would be learning around smart people, but where I would feel that I was not doing harm, that I could be proud of what I did every day. And I think for the most part, CII is on the side of the angels. We represent investors, and I feel proud of what we do here every day. So I feel good about coming to work. I didn't want to go into public relations because which is what a lot of journalists do, because I wanted more control over what my work life would be.
Well, great. Yeah, always helpful to have a journalist background when examining corporate governance in particular, I think. And so I really enjoy talking to journalists who cover these kind of things. Let's talk about, so we're talking about things like ESG and COVID, et cetera. I think it's fair to say that COVID has really impacted corporate governance, particularly during the proxy season. A lot of times we say, well, this was a proxy season like no other. Last year, it definitely was, clearly, in terms of how we conducted it. This year, it's also with a lot of the results and the outcomes. And so let's dive into that. But first, let's talk about virtual shareholder meetings. And so, as you said, CII, Rutgers, and the Society for Corporate Governance partnered on a very big project on virtual annual meetings from last year, just to see, the shift in the practice and where, where standard practices were developing. In year 2 of this kind of everybody being forced to do it, what kind of things have you seen and noticed any similarities or differences from last year?
That's a good point. The difference from last year, the big difference is that companies had time to prepare. They kind of knew in the last half of last year, in the late fall, that they're probably going to have to do this again. So unlike a year ago, when all of a sudden they had very little time to prepare, they had gone through this, and I think overall it's been better. It's hard to get a read on virtual shareholder meetings this year because we're in the middle of the proxy season, but CII has asked our members to let us know of any particular glitches or things that they liked about virtual meetings. And I know that some other organizations are doing the same thing. So the early indications are that there have been fewer technical problems of shareholders accessing virtual meetings, actually getting in, logging in. There were some problems last year. And I think that's probably because of an agreement among some of the proxy service providers on a technical fix to ensure that beneficial shareholders can get into meetings regardless of who's running the platform. And I don't want to get into the technicalities, but it seems to be doing better. There are some complaints, but overall it seems to be doing much better. And I think companies did a better job this year billboarding in the proxy statement and on the website of what you need, the documentation you need to enter a virtual meeting. I am still hearing some complaints about the Q&A portion of virtual meetings. Some companies only permitted questions that were submitted in advance and seemed to rattle off answers that were planned in advance. Maybe too little time for question and answers, or some didn't answer any questions. I think these are probably outliers, and some disgruntlement is probably inevitable about the Q&A session of a virtual meeting. Shareholders are always going to wonder if companies are cherry picking the questions or skipping over some questions to answer. I just think that it's just an unanswerable, it's just something we won't know. There has been some unnecessarily stringent policing of proponents, shareholder proponents. For example, limiting a proponent to only the exact words of the proposal and the supporting statement as printed in the proxy statement, and citing SEC rules as the reason for this. And Doug, you wrote about this in your blog, and it's clearly a misstatement of the rule. And the proponent pushed back and the company relented, but it's these sorts of nitpicky things that just give everybody a bad taste, and most companies try to do the right thing. So this sort of policing isn't necessary. I still think that too many virtual shareholder meetings have come off as canned productions. There's nothing terribly exciting. Few companies use video, so this is really like an annual shareholder meeting as conference call with some canned videos and slide decks thrown in. I think that's partly because the pandemic means that your directors are all over the country or all over the world, and that you can't have everybody in one place. I really hope that once the pandemic is truly behind us and all the directors of a company can gather in one place, that companies will experiment with hosting video virtual meetings. It's just much more realistic, and will tell your shareholders who's actually there, who's actually showing up, because not all directors do. And I think some companies will return to in-person, because for some particularly smaller companies, it may be cheaper to do that. And that's what many shareholders would prefer.
Yeah, I think that's right. I think next year will probably be the year we start to see some interesting things when people are trying to actually making choices. I mean, from what I've seen this year, it's been, some outliers doing some new things, outliers doing some bad things, and the vast majority are extremely boring and uncreative. So I'm not expecting much more over the next couple of weeks. Let's go into more of the exciting stuff. And so this year, executive compensation has been an issue, unlike it's been just in the past few years. And a lot of that has to do with COVID and how COVID affected the business and performance and how executives get paid in terms of hitting goals and stuff like that. And then, at the shareholder meetings, there's this say on pay vote where the shareholders can actually, vote to approve of the comp or not. It's not binding, but it's a pretty loud, it can be a very loud expression of satisfaction or dissatisfaction. So Amy, tell us a little bit about that whole story, both the kind of the COVID impacting the performance itself, and then also these voting results.
Right. Well, absolutely. Early voting results so far suggest that investors are scrutinizing compensation more closely this year. An early, one of the firms that tracks this has said that as of the middle of May, the failure rate, meaning percentage of companies who say and pay failed to receive majority support, was running at about 3.3%, and that sounds really small, but you compare that to the traditional sort of 2% every year that a failure rate for say and pay, then that's a big increase. 22 Russell 3000 companies, including at least 6 S&P 500 companies, failed to receive majority support. And then there's an untold number of companies that didn't even get, that didn't get to 70 or 80% support, and that's also telling. I think that many The backlash this year may stem from the bonus plan changes aimed at helping executives secure hefty bonuses during the pandemic, particularly during the stock market slump over a year ago. And the board's failure to provide a compelling rationale in the proxy statement for why they use this discretion. Why did they change plan targets? According to the FT reported earlier this month that more than 100 S&P 500 companies rewrote their bonus plans for executives as a result of the pandemic. Some eliminated the second quarter of 2020 from performance targets, making it really, that was the toughest quarter perhaps for many, making it easier for CEOs to achieve bigger bonuses. And it's not gone unnoticed by investors that adjustments and discretion are almost always used upward. Bonuses aren't reined in when companies benefit from positive market trends or market forces that are outside an executive's control. So I think it really behooves companies to, if you're going to use discretion, if you're going to change the targets or change the parameters, you better have a really good rationale and detail that in the proxy. I think investors understand that there is a need for discretion is legitimate at times, but explain how you're doing it and why.
I guess, some people say, well, look, last year it was really, really difficult for anybody to hit targets that were set before COVID was even a thing. And so if you set those targets thinking that this is going to be a normal year, and all of a sudden kind of this once in 100-year pandemic hits, shouldn't they make some adjustments because it's just so hard to predict what the company is going to be able to accomplish that year?
Investors have different views on this. Some would say yes, but again, explain. Don't just say because of COVID. That's no longer in it. You can't just say we use discretion because you need to explain why. And then there are other investors will say, well, it depends on the company. A company that laid off thousands of workers or forced many to take, furloughs or, whatever, that no, the CEO should suffer along with everybody else. And yes, a lot of CEOs did trim their salaries at the start of COVID or took salary cuts, but that's a fraction of the compensation that a typical CEO takes home.
And so, for these say on pay votes, the kind of so-called failing say on pay votes, you express as a percentage, it sounds very tiny, but in terms of kind of just gross, numbers, it's quite a bit, it's quite a bit different from your average year. And yes. I think lately you had high profile companies like GE and AT&T, right. Their pay, votes were failing. And so, at that point, you got to ask, well, if those companies are high profile and have a ton of investors, and so for that many to shift, what needs to happen on the investor side, in terms of, which investors need to kind of get mad for that kind of thing to happen?
Well, I think what we're seeing, and not just in say on pay, but across the range of issues this year, is a marked uptick in votes by large asset managers for shareholder proposals, against say on pay, against directors, not in any, not huge, but at the margins it's significant. And you're seeing this especially in climate related shareholder proposals, for example. And in a greater willingness to vote against directors. These are large mainstream asset managers that are, getting more discerning, and they're explaining, they're, putting out stewardship reports where they explain when they take votes against companies or against directors, why they're doing that. And I think that more activist bent is likely to persist for some time. No question, there's ongoing pressure from socially responsible investors and interest groups for leading money managers to walk the talk. BlackRock is a big focus for this concern, asset manager and the biggest index investor, and also has one of the most outspoken CEOs who has talked about climate change, risk being an investment risk, and all sorts of, makes all sorts of pronouncements. So the firm itself is being held to a higher standard, I think.
Yeah, so that actually brings up another interesting topic in terms of, some
I
speculate
think
that,
we're freezing.
well, we
Doug?
can see, we can hear you, so I guess we'll keep going. Unless someone tells me that we
I can't hear
stop.
anybody.
We can hear you just fine.
Yeah,
Um,
Amy, if you can hear us, we can hear you.
I can't hear anybody.
Okay, I think she said she can't hear anything.
You're breaking up.
Okay, hold on.
Oh, okay, you can hear me? Great, but I can't hear you.
You cannot hear me. Okay. Okay, let me just, I will type in some questions for Amy to hear. I'll ask her about stakeholder governance, which is what I wanted to kind of get into in terms of these large asset managers coming out with pretty bold statements about it's more about stakeholders rather than shareholders these days. All right.
Okay, I'll talk about, okay, just a sec. I think Doug has asked me to talk about stakeholder governance. And this is reference to the debate over stakeholder versus shareholder primacy that started with the Business Roundtable issued as a new definition of what it thought was the purpose of a corporation back. This was August of 2019. And my organization took issue with what the Business Roundtable said. And this became a big debate and stakeholder versus shareholder primacy. We all tend to focus on the differences of perspective and emphasis, but I think sometimes there's less of a chasm than we think. There's no question that the pandemic has turned up the heat on discussions around how companies treat their stakeholders, particularly their workers and suppliers. And there's still, I think, a lot of work to be done to take the stakeholders' interests into account. But clearly companies play a critical role in society, and they have broad responsibilities that must be met to create long-term value. And they for their companies to be successful for the long term, CEOs must treat key stakeholders, especially employees, with respect and consider their interests and views. They must also weigh and respond to long-term societal risks to which the company contributes and is affected by, like climate change. But what we thought was missing from the Business Roundtable statement and many of the discussions on stakeholder primacy is any accountability mechanism to those stakeholders. It seemed that CEOs who signed the Business Roundtable statement or their boards thought of themselves as the arbiters of that. Oh, should I call in or can you hear me? I thought you could all hear me. I'll just continue unless somebody tells me not to. Okay. So one of the problems, I'm sorry, I'm checking the chat box as we go along. There has to be an organizing principle, a North Star, and at CII, we think that accountability of management and the board to shareholders to deliver long-term value is that accountability mechanism. And I think one of the problems with the veneration of the so-called stakeholder model is that it conjures a win-win business environment, and there's always going to be trade-offs between stakeholders. Do you close a plant to save money, but you throw and improve the environment, but do you do that at the risk of throwing lots of people out of your employees out of work? Whose interest comes first? And I think saying all stakeholders are important doesn't offer a way to navigate such situations. I see limited headway in the US for companies to put other stakeholders' interests ahead of delivering long-term shareholder value because that conflicts with fiduciary obligations of boards to their shareholders. And if it's a company that's incorporated in Delaware law's business judgment rule already grants boards great discretion to take actions that will drive long-term value. And they can take steps to do that don't maximize profits in the short term if they think that doing so will enhance long-term value. And let's get real, only shareholders have the vote. And if they believe they're not being well served by directors, they will vote those directors out or pressure them to oust the CEO. And that's exhibit A for that is what happened to Emmanuel Faber, the former CEO of Danone, the French company. He promoted stakeholder capitalism, talked about how Danone was a purpose-driven company, reported carbon-adjusted earnings, but he didn't deliver robust growth or increased shareholder value. And activists, hedge fund activists, forced him, made a fuss about this, and he was forced to step down. So let me see where we are. Should I call in, or are we going to just continue this way? Okay, I'll dial in by phone. Let me log off and I will do that. Or I'll stay on.
Sorry, I'm telling Amy to pause and dial back in by phone. So thanks everyone for your patience. In the meantime, I think the question box is open. And so if anyone in the audience types in questions, I can incorporate those into the conversation. Otherwise, Arthur, are we going to open up the mics for people to, have live discussion?
That's fine with me if we want to do that towards a little bit more towards the end of the session.
Okay.
I'll double check, but I think that makes sense from my end.
Okay.
Participant ID followed by pound. Otherwise, just press pound to continue. You have joined the meeting as an attendee and will be muted. This meeting is being recorded.
It's muting me, I think.
Can you hear me, Amy?
Yes, I can.
Okay. Okay. So let's just continue like this. So I posed a question to you kind of further to this idea of the kind of the stakeholder model of governance having this reemergence of popularity. It's easy to see why the Business Roundtable would say that. There's just kind of people say, well, look, that's pretty self-serving. But for BlackRock, Larry Fink was really the first one to come out, guns blazing with, it's not all about the shareholders, the stakeholders are, important, and there's got to be a sense of purpose, etc. So why would the largest investors in the world be kind of moving away from shareholder primacy, which you would think is kind of their mantra, and towards essentially giving up some of the power?
I don't think they are. And I'm sorry if is there an echo?
It sounds fine to me.
Okay, great. If you look at the votes for the proposals that asked companies to switch to public benefit corporations, these were filed at a lot of the companies where the CEOs signed that Business Roundtable statement, including BlackRock. These proposals are getting really, really low support. So I don't think large asset managers or asset owners are willingly giving up their primacy.
Got it.
They're not supporting companies changing their stripes to become public benefit corporations.
Amy, if you hang up your video, I think your echo will go away, and just keep.
Okay, hang on. Let's see, Zoom.
Okay, Amy, are you there? Maybe I just gave bad advice. Okay, sorry again, everybody, about this. I'm going to try to cover with Amy the issue about CEOs speaking out on a number of issues in the past year, which is something that really didn't happen a lot before. Also ESG, Amy. Oh, Amy, you back? Oops.
Okay, can you hear me now?
Yes, we can. Thank you. So I was just explaining to the audience what I was going to ask you about next, which is, kind of related to this, the stakeholder love fest. The CEOs seem to be speaking out more on a whole host of issues, and not just talking about the bottom line, and keeping it about the business, but they're talking about social issues, political issues, climate change, election tampering, all this stuff. How do you, what do you make of this? And kind of as a spokesperson for these large investment funds, how do you feel about this?
I think this is really fascinating. And it didn't start with this latest issue of speaking out about the right to vote and voter suppression bills around the country. Think back to the so-called bathroom bills in North Carolina and elsewhere, support for LGBTQ rights generally, climate change, investments companies announced in affordable housing in Silicon Valley because their workers can't find a place to live. I think this reflects in part the war for talent and the growing need to make sure your company is viewed by the best and brightest as a good place to work. And that their own employees increasingly want to work for companies who share their values, that they think share their values. And so it reflects in part, I think, the changing nature of the workforce, more women, more employees of color and other minorities working at large companies, and CEOs being sensitive to not wanting to alienate an important part of their important asset. But it's risky. And a recent Fortune survey shows why. Some interesting data from the survey. They surveyed 500 CEOs, and half of them said about whether CEOs have responsibility to speak out, and half of them said yes, and we're going to keep it up, and the other half said no, we should pull back. And I think that's because there's such a risk that when you do speak out as a CEO, some of your employees and customers will agree with you and will go right on, and the other half may say, no, I don't agree with you. So there's a big risk of alienating a big chunk of your market or your employees. But we're seeing this across the board, as you note, in lots of different issues.
Yeah.
It started, and we didn't see in the past, CEOs just ducked, but I don't think you can duck anymore. And you're damned if you do and damned if you don't.
Yeah. I mean, that you have the Wall Street Journal writing a lot of editorials about, what they call woke capitalism,
right.
Term that I really just cringe at. But there's a lot of that. And also, I guess, kind of related to that, we can talk a little bit about ESG here, environmental social governance, and that's kind of really consumed a lot of the discussion in the corporate governance world. And it seems, again, like the largest asset managers and asset owners are all in on ESG, talking about ESG as, a risk mitigation investment strategy, risk mitigation business strategy, and then also perhaps creating alpha. And so, am I right when I kind of have this impression that the investors are just all in on ESG?
Not exactly. I think certainly the asset managers are pushing this really hard, and I think it's partly because of the reasons you cited. It's not because climate change and other ESG issues have political or social significance. It's because they increasingly view ESG risks and opportunities as material to investment and voting decisions. But there's also an element of marketing here. Everybody's trying to show that they're on board with ESG and they do it better than the other guy. To attract the capital investment fund of asset owners, pension funds and others. Our members run the gamut. Yes, many of our largest asset pension fund members, particularly on the coasts, are all in on ESG. But there are still plenty of pension funds, particularly public funds in the middle of the country, that are much more wary and their primary concern is generating returns to pay retirement benefits for their plan participants and their beneficiaries for decades to come. And they have a fiduciary duty, and some even have it written into statutes, state statutes, that they can only consider financial factors.
Oh, really?
So,
Wow, that's interesting.
Yeah, so not everybody is there. I mean, you hear about it because the largest do, but there are still some doubters, and we have to keep that in mind.
Yeah. Yeah. And I guess there was some controversy about certain investors talking to, or divesting of gun companies that make guns and all of that stuff. And I'm sure there are probably states out there with pension funds where a lot of their end beneficiaries are nervous about that.
Right. Well, I think if you look at, I think it's Texas that just the Texas legislature that has approved passed a couple of bills relating basically, or hands off, don't saying that the state pension plans can't invest money with folks who take climate change into consideration. I'm mangling the definition of what they said not to, but it's penalizing or not letting their state pension funds invest in certain kinds of companies that, or certain kinds of investments that may, sidestep gun manufacturers or, and a fossil fuel. So you need to be careful. I think one of the issues in ESG, though, is most companies make some sort of ESG disclosure, but they all follow different frameworks, or maybe don't follow any particular standardized framework. And the big problem is the lack of comparability and consistency of ESG disclosures. And investors want this sort of standardized disclosure so they can analyze across industries and sectors. And we don't have it.
And so, yeah, so that actually conveniently turns us to the SEC in terms of the regulatory body that could really require standardized metrics on a number of things beyond financial metrics. Mm-hmm. And so, we have a new presidential administration. With that, we have a new chair of the SEC, Gary Gensler. And let's talk a little bit about Gensler's agenda, stated agenda for his term at the SEC, and the things that CII is really tracking.
Okay. Well, I think overarching everything is climate change. This is the signature issue of the entire Biden administration. And it's, sometimes I feel like I've gotten whiplash from the previous administration to this administration, because the previous administration didn't want to talk about climate change. And everywhere you turn now, somebody's talking about climate change, from Janet Yellen at the Treasury to Gary Gensler at the SEC and all over the place. So I think the SEC is determined to propose mandatory disclosure requirements for companies on climate change. And he has also talked about required disclosures for human capital, i.e. workforce metrics. Just what that looks like, we haven't seen yet. And it's pretty clear that the business community wants principles-based rules that give companies maximum flexibility to disclose what they want, and an effective date, just shy of never for this to go into, take effect. And investors are not unified on what they want. Many of the most mainstream asset managers and asset owners would like the SEC to direct companies to report these climate change performance according to existing standards set by one of the existing private sector standard setters. It's a bunch of alphabet soup, but SASB, the Sustainability Accounting Standards Board, is increasingly being embraced by investors, and it has a series of industry-specific materiality-based standards for companies. But a vocal minority of investors thinks that's too narrow and wants companies to report not just on how climate change affects them financially, but also how the company's impact on society and the planet, kind of a broader view of materiality that I don't think that's where the SEC is going, but it's getting different. It has cross pressures in different ways.
Yeah, and obviously different industries, have different metrics that would be relevant to them.
Right.
So it's it's a very complex issue and something that obviously I think we're all following.
Right.
I guess another area where Gensler was kind of challenged in his confirmation hearings was this, the GameStop meme stocks, whatever you want to call it. CII recently put out a paper talking about the meme stock spectacle. And so I guess just tell us a little bit about, what prompted that and your members' concerns around what, largely happens in kind of the retail space.
Right. This is really more of a retail issue, though there's some overlap. But this all was generated by the explosion in January, even before Gensler was named or certainly confirmed, of the kind of frenzied trading in the GameStop, a company. And there have been other sort of so-called meme stocks that they get run up and crash and run up again for no apparent reason other than they're being talked about by folks who are trading and kind of gathering together online. And it's individuals. It's not institutions. And at a hearing in earlier this month, Chair Gensler said that, he said the SEC he's directed the SEC staff to look into a lot of these issues and report back. We'll probably see some of these reports and perhaps some indication of whether the SEC will take action or not by the end of the summer. Some of the issues that were highlighted were things like disclosure of short selling. There isn't much. A shorter trade settlement date, and maybe cleanup of the so-called gamification of trading. When it becomes like a casino or you get confetti when you hit a certain stock, your stock hits a certain price, that kind of thing. CII did we published an issue brief. It's not advocacy, it's just really an explainer on things like payment for order flow, short selling disclosure, and trade settlement. And just for our members to just try to get a handle on these issues, which are not things they ordinarily focus on.
Got it. Okay. I think, another thing that the SEC has talked about, but over time and really nothing's happened is, dual class stock. This, company is doing an IPO where the founders or large owners have stock where they have like 10 votes for stock for one share, and the rest have perhaps one vote per share or even less.
Right.
And so, where are things going with this in terms of your advocacy, and why aren't we seeing any real change here?
Well, you have to look small. The part of the problem is the SEC doesn't believe it has the authority to regulate in this on voting rights. It tried to 30 years ago, and there was a lawsuit, and since then, and the SEC lost, and since then it has backed off. Now, CII has pressed the stock exchanges to amend their listing standards to require that newly listed companies at least have sunset provisions. Newly listed companies that are dual class at least have built-in sunset provisions, time-based sunset provisions to revert to one share, one vote, within 7 years. And 7 years because recent academic research suggests that that's about the time when dual class structure stops becoming a value enhancement and starts to become negative. So we've been promoting dual sunset provisions, time-based sunset provisions for some time now. And, slowly it is catching on. We've had some success. Last year, 8 of the 17 dual class companies that IPO'd in the US did have sunset provisions ranging from 5 to 20 years. Airbnb was one of them. 7 to 10 years is more typical. But this is kind of a one-off. This is like, we're pushing this, and some asset owners and asset managers. We have also recently submitted draft legislation to the Senate Banking Committee that would direct the SEC to adopt rules requiring US exchanges to enact listing standards to bar any company with multiple share classes with unequal voting rights from listing if it doesn't have a time-based sunset. There's another provision in there relating to board diversity, but we're calling this the SEC's Investor Advocate Act of 2021 because it would implement recommendations outlined in the SEC Investor Advocate's 2020 annual report. So there is the SEC Investor Advocate is a foe of dual class shares and thinks the SEC needs to get real authority from Congress to legislate to regulate in this area. So we're encouraging the Senate to take an action. This is a long haul effort, but at least maybe we'll get some hearings out of it and get some attention to the issue of dual and triple class stock, because it's still a minority of companies that IPO in the US that have this, but it tends to be high tech companies with founder CEOs who really want to control their companies. They may be very proud of challenging, just the disruption they're causing to one industry after another. But when it comes to their own company, they want to put up walls and make sure that they can run the company as long as they want. And dual class stock lets them do that.
Got it. Let's talk. There's another thing out there that's been floating around, and the SEC actually has something on the table that they could adopt. They just haven't. Something called universal proxy, and maybe you just want to kind of. I know this is a priority for CII and a lot of asset managers, and so maybe just talk a little bit about that and why that is a priority.
Sure, thanks. And it's universal proxies are one of what I would consider low-hanging fruit for the SEC, the proposed reforms that aren't politically contentious in the way that climate change disclosure is, but these are things that have languished for years. A universal proxy rule was, the SEC first proposed that in 2016, so it's kind of gone nowhere. Universal proxies are for contested elections for board seats. Right now, if you vote by proxy rather than in person, as 90-something% of investors do, when there's a contest for board seats, you have to vote either on the company's proxy card or the dissidents. You can't mix and match, choose, I want to vote for these 3 director candidates from the management is nominating, and these 2 nominees from the dissidents card. Doug, you yourself have put it so well, and I've used this line a number of times. It's like going into a voting booth and only being able to vote for Democrats or only being able to vote for Republicans. That's how it works. And universal proxies would simply level the playing field so that investors voting by proxy could mix and match and vote for the combination of director nominees that they think best serves their interest. It's that simple. And it languished for a while because a lot of companies thought universal proxy would advantage dissidents, would help the challengers in a proxy contest. And now I think there's a greater understanding that it's very circumstance specific. It's case by case, and there's no guarantee that it'll help one side or the other. So a lot of the original hostility to universal proxies has faded away. So I'm hoping the SEC recently reproposed universal proxy rules, so I think that's a sign that they intend to adopt it sometime this year.
Got it.
But similarly, we hope the SEC will take action on a number of other things that have been hanging out there for a long time.
Well, since we don't have any questions coming in, maybe you want to start listing a couple of those. What's the other low-hanging fruit out there that you think just could be easily whacked and be, kind of just be done with?
Well, improvements to so-called Rule 10b5-1 trading plans. These are the rules that around which executives can sell company stock at a predetermined time and avoid insider trading charges. But there have been a lot of reports, both in the media and academic research, suggesting these plans are abused, and that there may be fortuitous trading. So some tightening of the rules and better disclosure. Congress has looked at this as well. There's also something going back to the 2010 Dodd-Frank Act directed the SEC to come up with rules for minimum standards for clawbacks of executive compensation, unearned executive compensation when there's been a problem. And that's been hanging out for a long time. The SEC proposed a rule back in 2015. We think they should finish it up. And lastly, vote confirmation. Right now, there's just no way for investors to confirm that when they vote by proxy, that their shares were voted as they intended. You can't just, with a few clicks on a keyboard, get a confirmation. Yes, you voted this way at this company, and get it confirmed. And that has to do with the very convoluted proxy plumbing that we have.
Got it.
We think those are easy fixes, relatively easy fixes.
Well, let's see. We've got a question coming in. So Amy, you mentioned the increase in shareholder downvoting or voting down executive compensation. As you noted, these votes are not binding. Is there any data on whether anything happens as a result of these negative votes?
I think, yes, in many cases, companies see the negative votes, or they see when they get high negatives on their say on pay, it's a warning shot to engage with those shareholders and find out what is it about their compensation plan that's irritating so many of their shareholders. Because ignoring that for a long time is like an open invitation to an activist hedge fund to come into the stock, for one thing. And it could also lead to the next year, or if you're investors, if they don't see change, voting directly against compensation committee chairs and other directors who serve on the compensation committee. And that's something most boards desperately want to avoid. And most companies want to avoid embarrassing their directors in that way. So there's good incentive to engage with shareholders and make some changes. And there is some research to suggest this does happen. You don't often see the same companies year after year get low say on pay support. Usually they take action, and the following year they get higher support for their say on pay proposals. There are a few outliers there, but not many.
And a big part of that you're saying is because they up the engagement once they get the message.
Yes.
Let's see, we've got another question in terms of, we were talking about the CII's priorities. So with so many members and pretty diverse set of types of funds, how does CII and its board or your staff or whoever kind of set the priorities for what you're going to focus on in any given year?
Well, that's a really good question. And, we were founded in 1985, and we've always been a big tent. And partly for that reason, we focus on governance. We do a lot of educational programming around the environmental and social issues, but we focus mainly on governance for two reasons, partly because that is where there's consensus around governance as a really critical issue. And also because we believe that corporate governance is the linchpin to ensuring that companies pay or boards pay appropriate attention to other issues like environmental and social issues. So, but within governance, we tend to focus on issues that affect all shareholders. The dual class is a good example. It's issues around the vote and shareholders' ability to vote. We focused on the different ways companies IPO, the rise of SPACs and direct listings, because they can curtail the ability of shareholders to get the information they need. So we look at we look at broad issues around governance in particular, and issues that affect a wide swath of institutional investors.
Got it. I know it's a tough job, and you've got, you know, a lot of different interests out there, and like you were saying, you know, different states with their different funds have different priorities and different investment strategies. So, but I think, you know, at this point we're coming around to 6 p.m. I don't see any more questions, and so you know, let's see. Okay, actually, we have one more question. You know, so in terms of CII, you know, I mean, to what degree are you actively lobbying? I mean, I think that you have, you know, registered lobbyists on staff, or maybe I'm wrong, but I know that you're always up on the Hill and the SEC, et cetera.
Yeah, our general counsel, Jeff Mahoney, does most of that. He's a registered lobbyist for us, but most of his lobbying is educational, meeting with particularly staffers for the House Financial Services Committee and Senate Banking Committee. They often call us or call on him to explain an issue or find an investor to testify at a hearing. You know, it's more about educating legislators on our issues than we're a nonprofit. We don't write checks. We don't make donations to campaign committees, and we don't have a PAC. So it's more in terms of you know, lobbying through education.
Got it. Okay. Well, I guess we'll wrap up now. Amy, really want to thank you for taking the time here, and for doing everything that you do in the name of corporate governance, and for being a collaborator with the Rutgers Center for Corporate Law and Governance. And I hope that continues. I believe this session has been recorded and will be there will be a link posted on the center's website at some point, so you can look forward to that. And I guess, Arthur, I'll turn it over to you.
Yeah. If I can just, I know we're bumping up against 6 o'clock, but if I can just very quickly say, Amy, thank you so much for taking the time to talk to us. I mean, these issues of transparency and activism and institutional authority that you've just outlined so well over the past hour, they're just so interesting and lasting, and we really very much appreciate your perspectives. Even though this was virtual and we had technical difficulties, you guys somehow managed to pull it off. So congratulations to both of you. Doug, thank you for your expertise in all things technology. I didn't know that was a great skill of yours. Now I do. Hopefully we'll be back to live programming, and we won't have these issues going forward. But really, thank you both for managing, despite the technical difficulties, to pull this off. And Amy, just thank you again for taking the time and for your very, very interesting remarks. We're very appreciative.
Well, thank you so much. It's been a pleasure, and keep up with the great work that you all do, because we need more education and knowledge about these issues. It's still, corporate governance is still a relatively young area, and people come to it from different backgrounds. So we need to develop more scholarship in this area. So
Yep.
Thank you, and thanks for having me.
And we will send that message to our students as well. So thanks, everybody. We'll end the meeting now, but we will continue the dialogue.
Thank you.
Thanks all.
All right. Thanks, Amy. Thanks, Arthur.
Thank you.
Take care.
Bye-bye.
Bye.